how you use them.
T-minus 3, 2, 1, 0, and liftoff.
Hello. Welcome to the Biz Doc Podcast. We got a few things today I'm really kind of excited about. We have an IPO coming. Very exciting. Is the IPO logjam going to break free? We're actually going to see some companies make it onto the market. Well, I've got a case study later today on a quick look at the Instacart IPO. There's a lot going on inside it, and I think we'll be taking a look at what that's all about. And first, we're going to jump into some stats. First of all, there's a little section called You Get What You Need. And I'm responding to you because there were several directed comments that came in that I want to talk to as people were talking about uncertainty. How is this going to play out? Will this ever matter in the future? I have a perspective from the BizDoc history that I'll share with you. Second, we've got Threads, Meta Threads. Is Threads fraying? Are we losing Threads? Remember, there's a big competition with what do we call it, Twitter or X or whatever they're branded this week. And Threads is not doing as well as people like to say. Well, at least some people are saying. Then mortgages are over 8%. Shocking, but true. So we'll first dive into those. I really appreciate a couple of comments that came in. And people were saying, there's so much going on right now. Is it all going to matter? Where is it going to go? And I think I know what you're thinking. The business news has been showing cracks. We've had consumers spending on their credit cards, and we have credit card debt in the United States here in August of 2023, closing out August of 2023, should I say, and we almost have $1 trillion of credit card debt. That's doubled in the past year and a half as people came out of COVID and was like, woohoo, spending again, spending beyond their means, and with inflation chasing them all the way from the gas pump to the grocery store, making them use those credit cards. Not fun. And people were talking about, where do I go from here? So you may be feeling those cracks. You may or may not be an owner. You may be, struggling to just make ends meet on your own as a leader of a very small business you're running, or you may be an owner of a business. And people have said, as things play out, one of the comments was, BizDoc, you've commented that over the course of time, things ultimately play out because great people find ways to manage through them, to bounce through them, or to take the L on something. Could be a business you started, could be a chapter in a business that's going to make it, and you take the L and you work on tomorrow. And I have a simple little formula that I use for this. And the first is the calm. Find the calm after the reaction and the anger. And don't hurt yourself with the anger. In other words, don't hurt yourself with your hurt. Like if a business goes down, you got to do something else for a while, that's a big hurt. But find the calm, point one. Point two, find the lesson. What can you take from this and what you work from this? This could be a defining moment and you don't even realize it. And I'm going to share something from my history in just a minute. And then lastly, the fire. Find a way to restart the fire with productive momentum going forward. So calm it down. Don't let the hurt you. Get yourself a lesson out of that so you really assess and understand what's happened. And finally, light the fire again and get going. And this is something you're going to do over and over again, whether you're a leader, whether you're an entrepreneur, as I like to say, whether you're running a t-shirt company in Berlin or a technology company here in the United States of America. It's all going to come down because you just don't know how it's going to shake out. And I'm going to share something deeply personal here. And this kind of goes down a personal path as well as the human path, because it's the people we work with that sometimes things happen and we don't know how and what we're gonna do with this. But I'll share something with you. So I was part of a startup entity inside corporate America. So in other words, there's this giant corporation that had started up a division. The division would later become bigger than the corporation itself. And so here we are at the early days of this thing, and it very much felt like a startup, except we were well-funded and had fairly reasonable offices and things like that. But every other thing about it was a startup, and people were gathering a lot of experience through it. And I had a great boss at that time, a guy I really liked. And there was a key moment for the company where somebody needed to step into a position, and I wanted to step into that position because it gave me another set of skills, not more money. It was going to be a lateral position where I went from what I was doing in marketing to driving sales on the front line. And so I really wanted that. And he ultimately, found another talent and brought him in. And I got him on the phone and I said, man, you know what, for the good of the company, for the good of our valuation, our profitability, I really think, you're making a mistake, because I'm not asking you for $1 more. We're going to press this thing. I'm going to expand my skill set, and I've got your back. I've got the back of the company, and there's so much here. We don't have time to experiment with other people. And he said, you need to relax. And I really laid it on the table for him. I said, this is a defining moment. This is a decision. It's not just about me. It's about, the company. And he finally said, you need to stand down. And I had a peer, a really good guy, who came in and said, hey, you may be right, but we need to let this go and move forward. And what happened was, that guy would later become my boss. When the boss that I had been jumping on, he went on to basically run the entire division. So the peer that says, hey, you got to find your calm, you got to find the lesson, and then find your fire to go forward, he ends up being my new boss. So my old boss is now running a division. He's my new boss. Now, there's a hidden part of this. On the human side, I also knew there's some demons in the closet that were chasing old boss around, and they weren't productive. And I was worried about him. No sooner than he goes to run the division, he ends up in a terrible divorce. He needs help down there. New boss, my colleague who had come alongside me and really been my flag carrier, said, hey, I need to get you down there, and you need to be basically his chief of staff and basically run the division and be there with him, because these demons aren't getting easier for him, and he's getting a bloody divorce now. By the way, this is all like in 9 months that all that chapter happened. So I went down there and I took that. So suddenly I had a bigger job, more responsibility, and there was a couple things that happened with the business that it was good that I was not there and then later was there, if I could tell you, the sequencing. So you just never know how things are going to play out. Well, there's another part of the story, is they asked me to go run the corporate venture group, from running the division to run the corporate venture group. And I was shocked. And if I don't do that, I don't step in to early stage companies, to venture funded companies, and away from my corporate existence forever. So that year defined my career. Also, I was in 2 and then 3 of the right places at the right time to truly impact the good of what was going on with the large corporation, the startup, and later the full venture side of it. Had all that not happened and I not been in those, someone else would have been in there, and maybe they would have differently than me. I happen to think I did a great job with it. But the point was, I just went with it, and how the people moved around. And these may be decisions you have to make with your people, that you make the best decisions for the company despite what people are pushing you on. A little bit of a sad side to the back of the story is after I went to run corporate, venture side, the old boss actually got remarried and didn't get a hold of his demons, and I got a phone call. And one night in a hotel, he passed away, succumbed to abusing his body and the demons he couldn't kick. And remember the guy that was my flag carrier that kind of talked me down, the peer that became my new boss? Well, he and I were asked by the widow to come do the eulogy for the old boss. And so those relationships come around, and they make a bond of tapestry that is unwavering. And I really feel right now, it almost feels like the human side of business is so important right now, because there's so many statistics and so many things out there that are so difficult. You just don't know how it's going to play out. And what I've just described there, where I go from being angry about what the guy didn't do for me, because I really thought I could help the company in another position, to being angry about what he didn't do for himself, which conquer his demons, and he's not here anymore. And there I was at the front of a church with my new boss doing a eulogy. And so those are the moments that define us as people. How does this relate? You may have great people that you're working with, and you may know exactly what to do. But there's another side to people under great stress, and I feel a lot of great stress right now is going on. And so I think now is the time to really, check ourselves and check the people around us, so that we are optimizing and caring for the folks that are out there. I wouldn't have brought this up And you say, gosh, BizDoc, this is so off track. Well, really it's not compared to some of the questions people have been asking. I've got a critical worker, but I'm starting to feel heat from the economy again. Do I keep him or her? And I'm not going to say what company or so that you can't kind of figure it out, but it's one of the valuetainers that's reached out to me. What do I do? How can I handle this? I got somebody who's, never really got their head in the game after this work from home thing, and I can't get them back in the office. They've been loyal all these years. What do I do? I gotta make a change here. Yeah, these are tough decisions that are coming down. So you may not know it, but you may be in a window right now that's going to be defining for your company. Just like I described an incredible 1-year window where I went through those steps, you may be going through those steps with your company. You make the best decision you know how, and you run through it, and you get ready to come out on the other side, because there's a lot of things to be learned. Resilience and tenacity for the economy, for yourself, those can be your best friends at times like now. And pay particular attention when you're going to be looking at it through the human lens and through some of the people that you have, because the people, the most valuable asset you have as you drive through this thing called the economy right now. Speaking of driving through the economy right now, I like to transition over to Meta. And we got a chart here that talks about the Meta Threads launch. So the Meta Threads launch, take a look at this. DAUs, daily active users. So you can see the top line there where the little Twitter bird becomes X, and you see what's going on. And after they rebranded to X, they've actually popped up to like a little half level higher in terms of daily active use. But now you go down below, and remember all the bragging about 4th of July? Hey, the real fireworks was Meta launching Threads, and we had 50 million users in no time. Yeah, well, take a look at that. According to some network sensing surveys that are run by independent companies who have put this together, and they said they are seeing network traffic that looks like this on the Android side, which means it's probably also looking like this on the iPhone side for Threads. Take a look at that. It's like it's had a big launch, a big hit, and now it's rolled down. So you know what? There's a lesson here for all of us. You can go out with a copycat product, and you can go out and go after a competitor. And I think the story isn't over for Threads, but it sure has not been a great 60 days. This has not been a little bit less than 60 days. They've gone from big launch to And that's what I think is because of the network effect that X has. They have an embedded base of people. You don't have to wait for things to mature and get better. And why would you join Threads and wait for it to become something when you can stay on Twitter and get news feeds? Because Twitter is very much a news feed now. And get news feeds and perspectives and things just like I do. I've got various groups set up for venture capital, private equity, certain things that I like in life, and business economic stats. And I get a lot of people in there. And the people that I think are full of crap, I don't follow them. But in the end, I have a beautiful news feed of a lot of folks that I've now curated. Why do I want to be on Threads and wait 2 years for all that to materialize? I don't. And for you with your company, be careful with copycat products that you're just trying to take a chunk out of a competitor. Here is a multi-billion-dollar example of how Threads may someday be significant, but that chart certainly shows that in the first 60 days, people zoomed up to get registered. And by the way, we're kind of forced and linked into Insta because the Insta registration is tied to Threads. And now see where it is. And so I saw that and I was just like, wow. Interested what you think. Leave a comment down below and let me know, because see if you're feeling or seeing what I'm feeling. But if you're going to go after Goliath, man, you better make sure that you are King David and you're anointed by God with the magic slingshot to go take care of it. Because it takes a lot to knock over Goliath. You know, more than a couple of headlines that says, Twitter is doomed. Yeah, that's an easy headline for news media to say. Now go do it in real life, where so many people are in love with Twitter, now X, appreciate what's going on in there, and are loyal to it, and like me, are getting a lot of the curation that they wanted out of the platform. So, speaking of something else that's going up, Meta was not going up. It seems that they're going down. Something bad that's going up. I got a couple charts here on mortgages. People have been asking, say, what do you see on mortgages? And I say, look, I see the same thing that you see. The Fed raised interest rates a few weeks ago, another quarter point, and said that they will be raising it one more time this year. Well, there's only 2 more times this year. They get together on September 19th and 20th for some meetings. And then they get together on October 31st, Halloween, November 1st. Those are only 2 times that the Fed will be getting together. So just a few days ago, at a place called Jackson Hole, Wyoming, Jerome Powell was up there giving a speech talking about what he's doing for the future and saying, I could see another quarter point increase in the in the national interest rate between now and the end of the year. Well, he's either talking about the September date or he's talking about October 31st, November 1st. Meanwhile, from the last rate increase, take a look at this. We're looking at an average mortgage projection, and I pull this off of Google, so I'm not really giving a plug to Google, but I'm giving a source to the chart. And I just said, okay, what if I'm in Florida and I put 20% down and I find a condo or something with a loan that's about $300,000? And let's say that my credit score is 700 to 719, so very respectable. The 30-year fixed is over 8%, and you can see the blue line, which is the 30-year fixed, the red line, which is the 15-year fixed. Take a look at what's going on there. They are creeping up, and they're not making it easy for the housing market. Now let's flip one more. We have one more chart. Now let's go look at California. And let's go look at a slightly more expensive house, because California is a little more expensive. So the next chart here, California, thank you. So I did a loan amount of $400,000, 20% down, California, and it's still 8%. So there are people that says, well, it's regional, there's some better rates here or there. Well, there may be, and maybe if you're with a credit union, you can get a slightly better interest rate on your mortgage, but you're not going to be able to defy gravity and get one for 4%. That's just not going to happen. And so we are now over 8% on it with 2 ways out. People say, you like to talk about the bad news, Biz Doc, but what's the way out? 2 things. 1, interest rates have to come down so that the corresponding bonds and then the mortgage rates can come down. That has to happen. Jerome Powell says he doesn't see it happening till middle of next year. So 2024, in the middle of the presidential primaries, trying to figure out which person is going to be president. In the middle of that, maybe we'll see interest rates come down at that time. But with inflation still hanging on at 3-4% right now, Powell's talking about one more interest rate increase here in one of those 2 meetings that I mentioned at the end of the year. So the first thing that needs to happen in the housing market is the rates have to come down. And when the rates come down, I believe that's when the supply is going to come up. Because right now, the only supply that's on the market that's growing is new housing starts. Now, they're down historically, but every time a new house gets built, even in today's miserable market, it's one more piece of inventory out there in the market for you and I to consider purchasing a home if it happens to be built in our neighborhood at a price point, in our city, in a neighborhood we like, at a price point we find, enticing. And so the first thing that we got to have is those interest rates come down. Then you're going to see people more willing to put their houses on the market. Right now, 30% of all homes that are owned in America are paid off, have 0 mortgage. The other 70%, there are a huge amount. What I've been reading is 45 to 50% have an interest rate on a mortgage of under 3.5, 3.5, 3.125, 3. Those people are not going to be selling that house and giving up that interest rate anytime soon. Heck, you could move to another city and maybe do an Airbnb in that house and have half a chance of being able to get rent that would cover it. So I think the interest rates have to come down. When they come down, that big chunk of inventory in there where people will be more willing to sell their house will pop out. Prices will come down a little bit, and I think there'll be a settling in the market, but not till the middle of next year. So action for you. Keep leasing, lease for a while, find yourself a comfortable situation, and ride out the storm, because it's probably going to be a year, this time next year, to where things will be loosening up a little bit. But that is what's going on. So I hope those 2 are useful for you. And now what I'm going to talk about is Instacart just filed their S1, and S1 is a document that's filed with the SEC. If you want to go check it out, go to www.sec.gov and look up Instacart. And they have a code name named Maple something, and you can find it. You can find it there. Go take a look. But now I'm going to go in the other room, go find my board, and we're going to break into a little bit of a case study and a dive into that Instagram IPO filing, or should I say, the finally filing, because people have been waiting for this for a long time. See you in a minute. All right, I found my board as usual. So let's talk a little bit about Instacart. By the way, that's the new logo. Remember how this kept changing? This was a carrot. Now it's a arrow to a bump. And still the carrot. It used to be the Instacart carrot. They've changed their logo like 3 or 4 times. But as they found a new logo, have they found profitability? Have they found a way to get through the IPO? Let's find out. So as usual, I'm going to take you through a couple quick things, and I'm going to analyze the point at hand. This is not going to be exhaustive deep dive. We're going to do that together as we see articles come out on this, but this is what I found very quickly, and I probably go deeper than most people do, so for some of you this may be pretty deep. So we start out with Apoorv Mehta, and he was one of the 3 founders. He had 2 guys that were also founders with him back, I think, 2010, 2012 in San Francisco. He would be CEO for a good while. Until the board finally, they're trying to figure out how to go forward. They want an ad strategy. They got some things going on. And they had a woman on the board, Fidji Simo. And she used to work at Facebook, and she was responsible for the Facebook app, and she worked directly for Mark Zuckerberg. Hey, that's not a bad person to have on the board. It's also not a bad person to have if you've decided that the founder CEO, one of the co-founders who was the CEO, maybe it's time for him to transition to the board, be more of an executive chairman. Maybe look at other things. Maybe Instacart was growing up and there is opportunity to do that. Well, that appears to be what the decision was made. So let's go take a look at the history and how that played off. Again, founded in 2012 by Apoorv and by Max Mullen and Brandon Leonardo. They're in San Francisco delivering groceries for a fee. Then they raised a bunch of money. There's a lot of that going on. I won't go through the series A, B, C, D, E, F, which is what it was up to this point, but I'll point something out, is they had trouble with the gig economy. The gig economy is where, like Uber drivers and Lyft drivers, remember they were trying to sue in California saying, excuse me, hey, we're W-2 employees. We're not 1099s. You're controlling a lot of it, so you should be paying taxes on us so that we don't have to pay the self-employment tax. That tax can be paid for you. And while you're at it, maybe some basic benefits or access to lower cost healthcare. Again, there's this big war that goes on when 1099s decide they want to be out there and they want to be W-2s. Well, nonetheless, Instacart found itself in the middle of that. And they had to make a settlement, and there is a lot that went back and forth on that. It would raise its ugly head a couple years later. Then they filed an S1, believe it or not, in August of 2019. They had raised $1.9 billion to date. Now, obviously, that didn't go out because they were heading right into COVID. There's a lot of other things. There's a joke about Instacart that says the only thing that's older than the company is its attempt to go public. There's been a lot going on there. Then, here it is, 2020, employees unionize in Illinois, and I think it was Skokie, Illinois. And there was also some layoffs later that had to do, and everybody that was laid off included a bunch of people that had attempted to unionize. So there was a little bit of a drama there. So Instacart's had its issue with unionization, the gig economy, and things that go along with that drama. Then in 2021, the board was like, we're just about, remember 2021, we're trying to bounce out of COVID. We're all struggling. 2022, we would get out, and Fidji becomes CEO and then chairman a short time later in 22, and they announced that one of those co-founders, Apoorv Mehta, was not going to stay with the company, that as soon as they're gone public, that he would be leaving for good. And he put out a nice statement, appeared to be cooperative with that, but it all indicated there was some drama and leadership behind the scenes, which I don't think is too unusual. After all, they had gone nearly 10 years grown significantly and had their issues. They had the issues with the 1099 W-2, and also right down here, take a look at this. In May of 22, they disclosed that they had sent a draft registration statement out to the SEC.gov, once again getting ready to refile the S-1 and go public. And in March, they had noted, yeah, we raised some money, rejiggered some things, and our valuation has gone to $24 billion from a high of $39 billion. Whoa, wait a minute. So you were a big unicorn at $39 billion, but now the valuation dropped all the way to 24. So there are some things going on behind the scenes. This is not a company, on a rocket sled to Mars, just going. This is a company that's got some drama there with the co-founder, CEO, some drama there with W-2 1099, and then apparently some drama on how they were doing below the surface and what that was doing to the valuation, and coming out of COVID when valuations were crazy. So this was kind of a surprise there as well. Then in 2023, just a week ago, they filed the S-1, and they announced that they had raised another $1 billion. And by the way, everybody knew this, but they put it all together. It was about $1 billion that had been raised between 2019 and 2022, bringing the grand total they've raised almost $2.9 billion. So just under $3 billion has been raised. So that's a quick history. There's a bunch of other things in there about sub-products, little things, buying a company. But nonetheless, this is the fortunes of Instacart. So now they come out and they said, we're going public. But here's something interesting to take a look at. There's a lot of interest in this. Even though, as I'm going to show you, I think that there's some headwinds and maybe there's some warts on this frog. You've got Goldman saying, we're going to go out with JP Morgan. By the way, it's Goldman leading it. So Goldman Sachs is leading, JP Morgan are the leading book running managers. But look at this, how it works in Wall Street. But BofA Securities, Barclays, and Citigroup are additional book running managers, known as additional, not junior, not co, additional. Everybody wants their place in the sun. And then this group, here we go, Baird, JMP Securities, the Citizens Companies, LionTree, Oppenheimer Company, Piper Sandler, SoFi, Stifel, Blaylock Van, Drexel Hamilton, Loop Capital Markets, Arcelos, Ramirez and Company, Stern, and Tigris Financial. They will act as co-managers. Now, let me tell you what that looks like. That looks like on the bottom of the prospectus document. It's going to look a lot like this, where the big font up at the top, Goldman Sachs and Company, and then additional book runners, BofA Securities, Barclays, and Citigroup there, and then everybody down there. So basically, everybody goes down a level and the font gets smaller. But nonetheless, this is a large group of people, and this is going to be a very large IPO if it gets out. Now, I think it's going to get out because I think they're all serious this time, but they're having to pre-seed. They've announced that people like Pepsi have already stepped up that said they're going to buy like $146 million or some number of it that Pepsi's already in. Why are they doing that? Because they want to go out with a prospectus and already have some early participants in the bag so that they can show, hey, they think the water's warm. Come on, jump in the pool. Let's go. So that's who's taking it out. And then, so now you ask a couple of questions. This is where I start diving in. Why go public now? Major players all have a play. Amazon has fresh. They're probably not going to buy Instacart. Walmart has grocery. They're not going to buy Instacart. I mean, you would think not because they already have a play and they're working on it. Google Express, they probably don't need Instacart if they've got that going. And Target bought Shipt. And that's the last one there is a little bit different. But the point is everybody's made a big play in delivery. So now let's take a look at the gig economy, because Instacart is definitely the gig economy, people delivering groceries for you and me for a fee on our groceries. And Airbnb is actually trading above the offering price. So let's take a look at the gig economy, because the gig economy is what they're jumping into the pool on. So how's that done on Wall Street? DoorDash is not above the IPO price. Uber is not above the IPO price. And Lyft is not above the IPO price. And so you take a look at all this and say, okay, Airbnb, and they're kind of not really a gig economy. They're almost like this barter economy in the middle. So The argument being that these gig economy, delivery economies, nobody has blown through the roof and gone to the moon over time like Microsoft did, just like a locomotive, go, 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 just keeps going up. Hasn't happened. So it may be that they need to do the IPO now where they think they have a window with some statistics so they could go out and get early investors monetized and then see if honestly they can make a play of this long term. Well, let's see what the numbers say. Here's revenue and net income. Very interesting. So 2020, 1.477 billion. Now that is their revenue. In other words, what they make on ads and fees delivering groceries. There's two revenue streams at Instacart, advertising and fees for delivering groceries. Then 2021, 1.834 billion. 2022, 2.551 billion. And then the first half, and I have this in a white box over here for a reason. The first half through June of this year, they're at 1.475. Well, you multiply that times 2, and that's 2.950. So that's definitely up over last year. Now take a look at this. Down there, the orange is the net income pre-tax, and the yellow is the net income with tax effect. As you can see, there is no real mark made on 20 and 21. But in 20 and 22, there was like a $460 million tax adjustment positive in their direction that allowed them to go out and say, oh, look at this, our net income was this. It's like, wait a minute. I dove into that. What the net income is really is from here to here. That's what it is, but $71 million. And then this year, it is much more promising. This 306 honestly compares here from operations, and then the 242 is after taxes. That's what you see with a healthy company. They have their net income before taxes and then the tax effect. So what they're doing is they're talking about 1.41825 billion, and we'll be at $600 million pre-tax. That's the story they're selling and saying, hey, that's why we think that we can get out and keep going. We've turned the corner. Well, how have they turned the corner? Let's go take a look, right? This is gross transaction value in billions. Would you like to see how people ordered groceries during COVID? They were at $5.1 billion of gross transaction volume. That's the total value of the grocery orders that they delivered. 5.1 billion 19, $20 billion in 2020. It was huge. What were we doing? We were using Instacart to deliver from our grocery store because they didn't want to go there because number one, you had to wear a mask. Number two, they only had so many people in at once. Number three, a lot of us were worried, I don't want to expose myself to COVID. Then 21, it was 24, and then 22, $28 billion. So the other thing that they're selling in the IPO is, hey, we got a jump thanks to COVID, but then people kept using Instacart. They kept going with it. Interesting, isn't that? So what do I think's up? Here's what I think up. Instacart in the S1 that I read, because I was particularly bored, they say they get $7 per order in customer service fee, but they get $3 per order in advertising. So advertising is 30% of the revenue that they were showing. And they also showed that the grocery growth has been flat for the trailing 12 months. And if the grocery growth is flat for the trailing 12 months, then that means that the real growth is coming from the ad dollars. And so if the growth is coming from the ad dollars, you don't want that. You want to be able to say that the underlying growth in delivery is what's growing. Because if the ad dollars slip and the underlying business is not doing well, you have a flag there. So that's a flag headwinds. And a lot of people, including me, are looking at this in the S1 going, wow, what's that all about? In other words, they're going to go on a road show and Vijay is going to have to go explain that to everybody. And check this out. I dove into it. I looked at the marketing line. I was kind of shocked. The customer acquisition cost, marketing, is $625 million a year, which is about 25% of revenue. And again, if I'm interpreting what they're showing in their S1, that's what the situation is. If it's different, then someone needs to take those many, many words of the S1 and make things a little bit more clear. it appears to me that it's up from 20% in 21 and 10% in 2020. And then the first half of this year that I showed you, that it's still 21, 22%, something in that range, which means, that this is still, a definite headwind. So I believe there's some headwinds here. This is what the roadshow is all about. They're going to have to go out and explain all this to the satisfaction of people. Meanwhile, they got, hey man, Pepsi just bought a chunk. They're already in for this. It's going to be a great IPO. And they've got a huge number of bankers, book runners, co-runners, additional runners, runners that are out there pushing this thing. And so that is my quick look at Instacart. Now, if you want to go back and look at the dawn of Instacart and the first chapter of it, in the comments, we're going to put a link to the Biz Doc original case study that I did on Instacart about 4 years ago. So take a little bit about to digest about the launch, how they raise money, how much they raise. And I put it all together in that case study. Meanwhile, we're all going to wait and see what happens to Instacart as they go on the road show and explain the answers to the questions that I've been asking. I'm going to go back to the main studio, and I'll see you in a second. Okay, I'm back. Well, thank you very much. I hope you enjoyed that. Please put some comments down below if you've got a company you'd like to see me dive into a case study on, or you've got comments about Instacart or have a perspective, or you read the S1 and there's something on page 142 that you think would be helpful to everybody else. Drop it in the comments. Let's open a dialogue. I appreciate all of that and more. This is until next week, where we'll have another case study and more stats on the Biz Doc Podcast. I'm Tom Ellsworth, the Biz Doc, and I hope I left you better than I found you.